Hey everybody, welcome back to For Starters. Today, I'm very happy to share a special announcement for our firm, which is the launch of CityRock Venture Partners Fund II. This is the second Series A focused fund within the AHL Ventures family of funds, and especially through a very difficult fundraising year, I'm so pleased and delighted and honored to be able to announce that we are formally closed. For those of you who don't know or who are just joining this channel, HL Ventures writ large is best understood as a company building ecosystem. Of course, we've been around for 15 years. We have our HL Studios funds, of which we have 3 vintages. We have our strategy group, and then we have CityRock Venture Partners, which is now on its second fund. That is our vehicle focused on Series A and Series B. And we were able to announce that our latest fund raised just under $24 million. And we are poised to be deploying that in support of our portfolio companies and looking for new deals as well. I wanted to take this opportunity to share with you just a few thoughts about the fundraising environment in venture capital and both in funds and startups in general, how that affected our fundraising process, and of course where we are in CityRock Fund II, which is a very exciting part of our cycle. As is no secret to anybody who's listening to this channel, the fundraising environment for the last 2 years really in venture capital has been super challenging. In fact, I'd say in almost 20 years of doing this work, it's been the worst environment, both for startups and for funds that I can remember. This is due to the confluence of a few things in the sector that together really made this quite challenging. Of course, the first is the rates environment. The rates environment, interest rates have made it, ironically, almost in many ways better, or at least an arguably better, a place to keep money in savings accounts and in bonds and other things that are generating what's called a risk-free rate of return than necessarily putting assets in riskier environments like venture capital. Of course, in venture capital, we're trying to generate probably the highest type of returns that there are in asset management, but there is a lot of risk in this environment, obviously. And when the risk-free rate of return is so high, a lot of the limited partners, the investors in venture funds say, well, why would I risk that kind of money when I have this kind of much more steady kind of, but still really meaningful income from the risk-free rate of return. This also didn't help us to have the bank failures last year, Silicon Valley Bank, First Republic, and others that were really distressed throughout the middle of the year. That put a lot of pressure on the sector, which relies on these banks. The net effect of all of that on the public markets, meaning the public markets came down, actually created another really complicated thing in the environment, which is the denominator effect, as we call it. The denominator effect is really if you have a large-scale asset manager and they have public and private assets, and then there's allocations that they're dependent on to keep between public and private assets, and then the public markets come down a lot, well, that leaves the private assets stranded at a higher number, and it looks like the balance between the public and private assets is out of whack, which is really an uncomfortable spot for a lot of the limited partners out there. And then finally, virtually every fund that I know was in the market either to call capital or to raise a next fund or to call special purpose capital to support its existing companies. And so there was really a confluence of re-up and capital call, which put a lot of pressure on the limited partners as well. So net, a really difficult fundraising environment for a whole bunch of reasons. And of course, again, for startups and for managers themselves. This led to a couple of things in the market that I'll share. PitchBook, the information source of record in our industry, noted, and again, I don't know if this is really true, it's hard to tell, but PitchBook says only 12 second-time funds were raised in 2023. That's a pretty breathtaking number. There's over 10,500 funds in America. CityRock Fund II is technically of its type, the second fund, and so we were very honored to be able to raise a fund in such a difficult environment. Equally interesting, 38% of funds really sat last year out. And that is both a pretty breathtaking statement as to the health of the space. It means that these funds are really focused on their internal portfolios or just not deploying at all. But it created an opportunity because despite all the things that I shared, this environment makes it really interesting to deploy new assets. And so with a new fund like CityRock Fund II, we were able to stay active, to stay out there, to be funding companies, and not just to be supporting our existing portfolio companies, but to be investing in new companies as well, in an environment that is arguably a much more kind of sane funding environment with evaluations that have come back a lot. This is also generating a moment that I think is important in venture capital, and we'll see if it really plays out in long-term changes. But venture capital is an industry which you've heard me many times talk about, needs a bit of a reboot in a number of ways. And some of the new focus in the sector on profitability, on outcomes, on the health of the companies and their balance sheets, on raising reasonable amounts of of capital at reasonable valuations. These are things that are now in the market. They are market norms that certainly were not the case 2 to 3 years ago. This focuses me then on the new approach that's the hallmark of HL Ventures and of the CityRock funds. We are focused on two things that are really the hallmark of our fund. The first is our focus on investing at the nexus of growth, impact, and diversity. That's high growth, tech-enabled startups that have a positive impact on people or the planet or both, and that we have a strong preference for underrepresented founding teams. And that nexus is both really important, especially in times like these when the world needs all the impactful companies and innovation it can get, and also when underrepresented founders find it even harder to access the capital and resources necessary to grow than normal. And certainly the last 2 years have been that. So it's really called our mission and our purpose into focus. The other hallmark of our fund is the hands-on approach. Many of you know that we practice something called daily active engagement here, which is to, as often as possible, virtually every day be in contact with every portfolio company. That is something that's good in general. We think of it as a really important part of our strategy, really the central differentiator for our fund, but also even more important in times like these, where even the most capable founders and fantastic companies have needed hands-on support of all kinds from our team. So I wanted to share this announcement with you all and a little bit of this context. I'm really pleased to announce also that we've made 6 primary investments from this fund already. From prior portfolios, we've been able to deploy this fund in support of energy efficiency company Sealed and healthcare AI company Sourcero. Joining those two are new Fund II investments, Meraxa in the data streaming space, Automotus in the urban future and intelligent camera space, Glacier Grid in energy efficiency as well, focused on commercial refrigerators and the refrigerator as a battery, as it were, and Monument, which is in the future of health and health payments, initially focused on alcohol use disorders, but selling through the enterprise a really awesome new solution in the healthcare space. We've also been able to accomplish 8 investments out of our seed program in Fund II, which supports our existing studio companies. So again, for us, this has presented an opportunity to be very active, to support the ecosystem and to live out our mission as well as possible. What I'll end on here is some deep and heartfelt thanks, without which we couldn't do this. Our team and the founders of our companies, of course, are just incredibly important parts of our ecosystem. We could not do this fundraise, we could not deploy these assets without such a great team and such terrific founders to back. And of course, last but not least, the limited partners, the investors who saw fit to entrust us with their capital. We thank you, and we look forward to working with you for the life of this fund. So thanks everybody for tuning in. We look forward to seeing you again soon. And again, very happy and honored and delighted to announce the launch of CityRock Fund II. Have a great day.